Major support for these broadcasts is provided by the CUNY TV Foundation, New York Community Bank, Kilroy Architectural Windows, New York's window company, Capital One Bank, Perfect Building Maintenance, Chase Commercial Term Lending, Geneva Burns, Giantomasi and Webster, M&T Bank, the Wickoff Group, Chelsea Lighting, Greenberg Traurig, LLP. Additional support is provided by Ackman Ziff Real Estate, AKA Hotels, Corman Communities, Bank of America, Merrill Lynch, Bank Leumi, USA, Briarwood Organization, CBRE, Colliers International, NYC, Cushman & Wakefield, DDG, Douglaston Development, Levine Builders, Dime Savings Bank of Williamsburg, Eastern Union Funding, Flushing Bank, Friedman LLP, Herrick Feinstein LLP, Hersha Hospitality Trust, Investors Bank, New Banks, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katzimatidis, Red Apple Group, Margolin Weiner and Evans, Madison Realty Capital, Meridian Capital Group, Newmark Grubb Knight Frank, People's United Bank, Popular Community Bank, SJP Properties, Sterling & Sterling, Stonehenge Partners, Urban American, and these friends.
Residential development in New York City is on fire. There are cranes being coming up all over the city. Everybody wants to be in New York City. So what's going on? Who's building? Who's lending? Where do we see it? Prices are rising. So today I've assembled this group of experts. I don't know if they are, but this group of experts to provide their insight on the state of residential development in New York City. My guests today include one banker, Steve Kenny, who is the market manager for New York and New Jersey for Bank of America Merrill Lynch. Hal Fettner, who is the principal at SF Holdings. Jim Hedden, who is the senior managing director for development at Rose Associates. And last but not least, Jeff Levine. My friend Jeff Levine, who is the principal of Douglaston Development. And do you still go under the name of Levine Builders?
Absolutely.
Okay. So, you know, it's interesting. 3 developers and 1 banker, it's like a party for you, right?
Yeah, usually we have the developers outnumbered, but I guess I'm getting tougher.
You know, you're getting tougher. So, banker, how do you see this market? We were saying prior to the show that the world like opened up, inflamed overnight. What are you seeing happening?
A lot of what you just said. You know, I'll put it in context. Just, you know, our portfolio today consists of several $billion in 17 transactions in multifamily housing, rental jobs, about 75% of which are here in New York. The balance are in 5 other states. We retain about 30% of that book, and then we've done several $1 billion in 10 transactions on the condominium development side as well. We, again, retained about 25% of those assets. And then in our pipeline today, we're looking at, you know, predominantly multifamily on the development side. There's half a dozen transactions that we're working on. You know, I look to these guys to tell me what they're seeing for the prices of dirt. You know, I think the good news on many of the assets that we've financed thus far, many of those, the dirt on many of those transactions was purchased in a legacy time period, and you're starting to see rising prices that are going to make it more difficult.
Let's forget legacy time when they bought the dirt cheap. I'm in the summer of 2013, where prices for land are probably at all-time record highs?
Absolutely.
Is construction reaching the levels that it used to reach, the cost of construction, or are we still below the cost of construction?
No, we're right now you're seeing cost of construction rising very quickly. We're getting pretty close.
So I'm seeing higher price for the dirt. I'm seeing higher price for the construction, and I see a lot of development. is everybody going to survive? I mean, I'm not worried about your portfolio because it's, as you have a big opportunity. You can selectively pick out who you want to deal with. You know, you have this large situation, and you also have the capability of doing the mega deals. You can do it with the families, the established rows, the people sitting over here. But, you know, there are, and as I sat with a contemporary of yours, Rick Lyon, yesterday in the morning, I said, how do you make the determination of which developer, who's the next Jeff Levine, who's the next Rose Associates, who's the next Hal Fetner? Because some of these young kids who think they're developers are coming to you today. How do you, and they're paying prices which you and I and everybody sitting here says,
yeah, look, as you
crazy.
just said, we have the luxury of being very selective. So what we try to do at Bank of America Merrill Lynch is we want to identify those people that can be somebody that we can do business with for the next decade. So what we try to do is start on non-development deals so that we have existing cash flow, we identify and start to work together with them in something that has less risk than the development business. And then over time, and depending on the management depth that they have, the access to capital that they have, and then the demonstrated relationship that they have with us.
So since I will shrink it, I will shrink it into a simple word. We want to feel very comfortable with that potential sponsor before we lend. That's why you'd like to lend to these three people. You and him are fighting, or not fighting, you know, trying to get the same property, as well as him over there. All three of you are going to selected markets. Aren't prices a little crazy, as one would say in the proverbial terminology? Aren't they Michigan already?
Well, there is an irrational exuberance that has overcome the land acquisition market. There are people, as you were indicating, that may not have been around for the past 30 or 35 years like some of the rest of us, who have seen these cycles come and go, who realize that these sales prices that we're seeing today based upon these historically low interest rates, which seems to be about ready to change, which are based upon prices that people are paying for condominiums at the moment, where we have a very limited supply because we have not built condominiums as a result of the Great Recession over the last 5 years. So the demand has come back based upon the low interest rates, the improving stock market, the flight of capital from foreign countries. But the supply is very limited, and I think that's created a spike in condominium values that I'd like to see for a slightly longer term before I dip my toe in that water.
So what you're basically saying, you have a number of developments. I mean, in Brooklyn, you're once again building a rental over there, and you're building in Manhattan. You're building in Manhattan a rental, at least one, and you're involved with a number of deals. You're more geared to the residential rental. Why do you prefer rental as opposed to sale today, Hal?
You know what? We always take the attitude that we're in the business to create cash flow, and we are very long-term minded. So in a perfect world, we love building our rentals, putting them away, and then moving on to the next deal. And while some other developers are merchant-type builders that will build it, rent it up, and then sell it, our model is very different. You know, you made a reference, though, a second ago to the audience about Jeff and I. We do go after the same assets, and the same assets that we are after.
So does Mr. Hedden.
Well, but on a recent transaction, we were both dealing with a wealthy foreigner. And we don't have to talk about the site, but the interesting thing here is that that site will be a rental. There might be some condo piece if Jeff decides. Jeff actually, unfortunately, won. I lost. But
That's why we put you separated from each other.
No, if I'm going to lose, I like to lose to Jeff. But the point here is
If I'm
that,
going to win, I'd like to be you, Hal. No.
but, if, you know, but the point here is that that property will be a rental, not a condo. Why? Because the landowner is not selling the land. He sees the value in the rental long term as well.
Right.
He'll come on as a partner.
Yes, in the lease or in the structure. But the point is that creating rentals, it's much more difficult. It's much more difficult because the initial returns may not be as great. In the world of structured finance today, where you're going to see maybe 60 to 65% senior debt.
You know something, but you just brought up.
It's hard to raise capital in that.
Yes.
But you know, I saw a number of mezzanine lenders and preferred equity lenders who are telling me that the capital stack, even though you're at 65%,
65.
okay, I can get to 80. I
Not
can
on a
get to
rental.
80.
Yeah, it's very difficult to put a mezzanine lender.
No,
into
not
a
on
rental
a rental. I'm more on a condo
Exactly.
over there. And we're
It's not
seeing
so-
it.
But on
So
a
then it's
rental,
equity and it's at a very low return.
But it's
going
like
in.
the stock market. People are chasing return, and they can achieve or think they're going to achieve more return when they do a condominium where the equity fund or the hedge fund is talking, the investment banking fund is talking about hurdles and preferred interest rates of low teens, whereas in a rental, that can't be achieved. So all of that money is out of the capital stack. So it's only your own equity and the equity of rational insurance
Long-term.
companies,
Long-term.
pension funds, rational investors that understand this is a marathon, not a sprint.
How many developments are you involved with today?
We have 8, maybe 7 that we're working on right now in various stages.
Okay. And all of them are rentals?
One has a condo component to it, but again, that's a way to take some of the edge off of the price is to sort of have a multi-use building. Retail is very important, so when you talk about just general numbers of $600–700 a square foot, it really depends on where you are. If it's a pure condo play, we probably aren't going to play that game at those prices.
Now, what about, and this is, Jeff has been in Williamsburg, built the Edge, a great project, really great sale. Now you're building a rental over there. You had something in Long Island City, right? But really most of your work has always been in Manhattan. Before now, most of your work has been in Manhattan.
We have a project opening up in August in Long Island City, and we have another site in downtown Brooklyn that we're working on.
Right, but so
Yes.
where,
Love it.
and so you
We love it.
You're bullish on Brooklyn?
Absolutely. In Manhattan, we're opening up on 77th Street, the Large Strand, next week, actually. Our rents there, we expect to break an average of $100 a square foot.
$100.
When you're getting $100 a square foot in Manhattan, and I think to do anything in Manhattan, you can't pencil in a rent less than $75 a square foot. Right. That makes rent in Long Island City at $50 a square foot really a sweet spot, because that's where we believe the growth is going to be. And I would say that of downtown Brooklyn. I would say that north in Manhattan.
Well, what you're also saying is that rents are reaching a natural ceiling. There's a limit to how much people will pay for a studio, where it's $3,000 or $4,000.
I believe where he is on the west side.
It's a 3-bedroom.
That's a different neighborhood.
3-bedroom.
That's a totally different neighborhood.
Absolutely.
There's a limitation. There's not anything around there, and people want to be in that market. Downtown Brooklyn, it's growing, and it's a 50. It's more than 50 because some deals are projecting 65. I mean, I just recently did a little analysis, and I remember when Avalon Bay built Myrtle, they were getting 40. I recently checked their website; they're at 55, $60 a foot on Myrtle Avenue over there. Mm-hmm. How do you, as a banker, look at the boroughs? Long Island City, Brooklyn.
I would echo what Jim said, and I think I would add to that by saying that there's so much money, and Jeff said it before, there's an influx of foreign capital and capital from non-traditional sources that's come to New York, and they define New York really as Manhattan. And so I think that there's more value from a land perspective in the outer boroughs today. That will catch up as well, but there's an opportunity to go and buy sites today, and a year ago it would have been better, but that the capital that's moving out there will realize that opportunity.
People, when we talk, as I always say, there are 5 boroughs, and very few people ever think of new development in the Bronx as limited. It was mostly affordable, and there's really not new regular rental development in the Bronx. Staten Island, because of the limitation of transportation, the accessibility. So in essence,
I would expect we're going to do a deal in Staten Island either by the end of this year or early 14 for a client.
But you have to look at every different neighborhood for its different purposes.
Right.
Yes, you said we are doing affordable work in the Bronx right now.
That's right.
But there's great retail opportunities coupled with that affordable.
But I believe that relates to exactly, you know, on the west side or any urban retail today. I mean, you have the project on 6th Avenue with the Durst family. You know, urban retail is fantastic anywhere in the 5 boroughs. It doesn't matter. The 5 boroughs are under retail for that.
But on that site, we bought it for the residential, and we bought it years ago. The retail has caught up and has become very, very valuable. When we first bought it, we looked at it, we said, all right, we got retail. We really didn't focus on the retail. Now we're focused on that retail.
But how do you look at other, you know, we're talking about Brooklyn, and I still, you know, and there was an article in the Times the other day about the guy Harris Burard who had something in Coney Island. You know, Coney Island, you know, it's the water. You know, it has potential opportunities. As a banker, would you look at Coney Island? As a developer, would you look at Coney Island? I'm not talking about Bed-Stuy, but Bed-Stuy is good.
What I always say is I follow the equity. So where the equity goes, and if it's the right equity and the right sponsor, and then we like the transaction, you know, we'll lend in any neighborhood that our clients are developing.
I think maybe you're not correct on that. If the developer's developing, I agree with you. But Long Island City has great transportation.
Yes.
And TOD is the key. Transit-oriented development.
15 minutes to Midtown.
Right. Then I happened to be today, I was doing an inspection. I was in Astoria. The banker dropped me off. I took the number 7 train. Not 15 minutes, but like 6 minutes.
It's 6 minutes and then 10 minutes to walk to the site, right?
Right. but what I'm saying to you is the negative of Coney Island right now
It's a long way.
it's a 1-hour trip.
It's more than the transportation. Coney Island is a problem.
Is
the infrastructure is a problem. The social amenities of retail are a problem. If they improve the transportation, it can happen.
But now but you know what the interesting thing is? Josh Musso, a mutual friend who built the Oceana, who had the same distance in transportation because Coney Island and Brighton Beach are the same subway situation. But his development or the community that he went after, which was a highly Russian community, they didn't care about the transportation. They, you know, and it was a condo development, and he sold out, and he's building.
You're building to a local market, though. They're not really. They're not counting on New York City or Manhattan.
But
It's an
where-
apples to
where
orange
Josh-
comparison.
Right.
is
Where
ultimately
Josh
what it
built in Brighton Beach had a housing component in the Mitchell-Lama housing there, whether it was Trump Village or Wabash Village, that created an anchor for retail and for amenities and for society over there. If you go to Rockaway or Coney Island, where historically you had low-income housing, which doesn't lend itself to disposable revenue to build up the retail in the community. So you had very negative elements over there which have not yet been
So
overcome.
here's my question: how high can it go? I mean, we were talking before about land. I mean, if I sat with all of you 5 years ago and I said, land for $750 a developable foot. Tribeca, I mean, Joe McMillan buying, you know, the Tootsie Roll factory for $800 a foot or something like that. You'd say, oh, you must be, it must be sickness. You know, you must be on steroids. How high do you see prices going?
I think, you know, in some part you're seeing an aberration because the world economy, look, the U.S. economy is still considered to be a safe haven. And I think a lot of what you're seeing as a result, the bubble in the condo market, I think is a result of foreign money.
And when you say the U.S. market, there are really only 4 parts of the U.S. market that are booming the way New York is. It's New York, it's Miami, it's San Francisco, and to some degree, I guess it's also Houston because of the oil boom that's going on there.
I don't see you going to Houston yet.
No.
Okay. How hard is it for you to develop today?
To find sites.
To find sites?
It's very hard to find sites. It's, you know, the landowner, they see these $600-700 numbers. And a lot of the deals that we're looking at right now are landowners who want to contribute their land. Right. They think they want to contribute their land and stay in on a long-term basis. But then when I show them that it will only work on a rental basis at a value of $200, $225, maybe $250, you know, they take a step back. So we have spun our wheels a number of times looking at deals with people who want to contribute land. Buying land today to do a future rental is almost impossible when you look at not only the land cost, construction cost, you have to then factor in the taxes that we're paying right now or projecting when a Bank of America underwrites our deals. They're now looking at a much higher reserve on for taxes because of the tax structure in the city. So it is very hard to do rentals today.
But I think you now brought up one of the biggest problems that we have in the city with regard to residential development, real estate taxes. I mean, of rent today, that could equal $20, $25 a square foot?
Well, the rule of thumb formula is that roughly 25% of your gross rent is going to be your taxes.
And
It's higher.
It's going higher. I think the banks are underwriting at a high rate. That's
Yeah.
the point that
what are
you
you
were making.
underwriting your taxes at now?
30%.
Yeah.
Right. And I think that's coming out of, Department of Finance. So the 421A program is a huge component to rental housing in the five boroughs.
Yeah, but the reality is a 10-year 421A is meaningless economically.
10 years.
because-
No, it has to be a,
Yeah, right.
yeah.
Now, Long Island City, you had a 15-year 421A?
We do.
Okay. When you look at a deal, don't you want a tax abatement? I mean, because immediately, how could somebody rent it up and afford it?
I'll leave that for these guys, but from my perspective, it's about what's net effective rent.
It's economic, right?
It's
It's all
economic.
economic.
No,
so
okay.
you can't just pick on one particular component of the transaction, and I'm sure that's New York City's argument is rents are unabatedly going up.
That's what
Why
we're
do we have to control taxes?
that's what we're facing now as you
And
look
at some
these,
point,
sorry.
Jim, you said it before.
Yeah.
At some point, or somebody did, if you have to pencil $75 or north, at some point there's an absolute dollar limit to the absorption at that price point.
But
And we haven't hit it yet.
Wait a second, but I believe you've reached the comment. People can afford. It's like people living in Stuytown. They would they take apartments and they put 4 shares in the apartments and so on. There's a question of how much someone could pay. Rule of thumb when I was younger and when it was 33%, 30%.
New York
New
has been
paradigm.
50.
It's a new paradigm. It's 50%. And you will share your apartment. And you're willing to spend much more of your income towards housing. And my daughter recently moved to a job outside of Manhattan. She remains to live in Manhattan. She does not want to live in the suburbs. She wants to maintain her lifestyle in Manhattan. Manhattan is a lifestyle that people are gravitating.
So they're paying for the lifestyle, and the location,
Absolutely.
not just the building itself, which is why the amenity packages have to be.
They're changing.
You need the roofs, the terraces,
Which
the
is
party
why,
rooms, et
getting
cetera.
back to what you said earlier about being in the places where people want to be. We love Brooklyn, young people want to be there. They want to be in Williamsburg. We together love the West Chelsea area because it is young, it is vibrant, and things are happening over there.
Now, we are not building Battery Park City anymore because we didn't need the dirt from where they built the World Trade Center, and we have a limited amount of land. Where is the next horizon, the next opportunity? Is it Washington Heights? Do you see more? You were a visionary when you went into Harlem a number of years ago. Do you see? Do we see East, West Harlem? Do we see where can we build? Because there's only X amount of land.
Well, to some degree, you have to follow the transportation, you have to follow the zoning. There's still a lot that is unbuilt in the Long Island City and Greenpoint areas. I think when you go up to Harlem, there's still some zoning that occurs near transportation in Harlem. Obviously, there are sites in downtown Manhattan which has not caught up, frankly, on the rental rates, but it has the transportation, and it is gradually
And
evolving.
what about?
to
And
amenity
I
retail.
know you're looking at it. What about the Seward Park, the Lower East Side? Do you see how many units will possibly be built there?
Well, there is an RFP that is being done in Seward Park. It's an area where, again, the zoning will support a great deal of both affordable and market rate housing.
I think that, yes, the Lower
area.
East Side is an area that has great potential for the future.
I would say the three neighborhoods I hear the most about in talking to clients is Greenpoint, Lower East Side, and Jersey City.
And what about Hunters Point?
Not as much.
Well, Hunters Point has the potential. It's got the zoning.
But it doesn't have the transportation.
Again, it needs
Right.
help with
Greenpoint,
transportation.
Greenpoint has the same challenge.
And Bushwick?
It's a little further out on the train. It's just
Now,
it's
you-
expanding the ring.
Now, you said you were looking at Staten Island. I mean, Staten Island does not have subway, okay? You know, the buses are limited. You have to get over there. I mean,
But Staten Island is fertile for other uses. We are currently building, in association with the Metropolitan Council of Jewish
right, you're building
Property,
a
seniors
assisted
project.
senior.
And we
sen-
expect to do more seniors project
And
on Staten Island.
Staten Island's a unique place in New York. There are many people that live there today and that want to live in Staten Island.
It's a great
So-
place. I mean, it's just
So
it's
I view it as a niche market. I said earlier we have 17 multifamily deals on our books right now. Are we going to end up with 17 in Staten Island? No, but for the right client with the right metrics, we
But
think
there are
that,
people planning great things for Staten Island. The city has put forth
Yep.
this wheel, this London-type wheel, which is in the planning stages.
It's definitely going to happen, and
There's an
there's also
outlet mall
there's an
that is
outlet
being
mall
planned.
that's being planned over there. Now, as you said, you're in New York and New Jersey. Where do you see the best opportunity in New Jersey? He's not allowed to go in New Jersey, either is he. And I'm not sure if Hedden has made his way into New Jersey. How do you see Jersey City?
predominantly Jersey City, but then progressing westward. Harrison is probably the next frontier. Secaucus, and we've financed projects in all three of
And
those
it's all about the
marketplaces.
transportation
Right.
for work in New York City.
Wait, there's great transportation in Newark. What about Newark?
We have not seen any requests for it, but
With the exception of when we went there on our trip. What about you guys going to the outer boroughs, and not the outer boroughs, the Garden State, or Westchester?
Look, we're bullish. If we thought we could make money, we would do that. I mean, I'll call it the downturn, we sort of looked at a lot of different alternatives, and what we realized is what we had right in our backyard is the best fertile ground. And so why venture off where you can't utilize your whole platform and resources, right? We're strong here. Everybody wants to be here, so we should take advantage of New York City.
One quick question about the Midtown zoning, the rezoning. Part of the Midtown zoning, would that be for residential also?
There is a possibility to do some residential development, but it's difficult since much of the existing commercial buildings are difficult to integrate with residential.
Why? I mean, Rose Associates
Core
has a building
elevators, you have to have the scale, you
Right.
need the elevators to service residential above an existing commercial facility. It's a difficult transition.
What about
It's not dissimilar to downtown. I mean, we're doing 70 Pine. We're converting the old AIG building. It's 1 million square feet. You have floor plates that aren't really conducive to a residential conversion, but you can do it. And there's
But here's, because we really have not too much time left, but what really helped Lower Manhattan in the early 90s was the 421Gs.
correct.
And we take, the full tax abatements, and right now we have a lot of new office space being built in Lower Manhattan. We have office space being built in the Hudson Yards. We have plans for office space over here in Midtown. I think what the city might need is to resurrect a tax abate program in Lower Manhattan.
I think certainly that would help the transition.
Okay. So I think, with 3 developers and 1 baby banker, a small little bank, Bank of America, I think that we've got a pretty good idea on development. And as the shiny apples would say, it's a bullish time over here for the residential development, for both rental and for condominiums. And I'd like to thank Stephen, Hal, Jim, and last but definitely not least, Mr. Levine, Jeffrey, for being here.